Think of your credit score as your financial passport for the modern world. It is the single most important number in your financial life because it dictates exactly how much the world trusts you with money. When you go to a dealership to buy your first car, the person sitting across from the desk is not looking at your personality or your hard work. They are looking at a 3-digit number that tells them if you are a safe bet or a liability. If your score is high, you might walk away with an interest rate of 3%, but if it is low, you could be stuck with 15%. This massive difference could cost you thousands of dollars over the life of a simple loan. Understanding this number is the first step toward true financial freedom and building real wealth over time. Your credit score is the foundation upon which your entire financial future is built. At its most basic level, a credit score is a mathematical snapshot of your reliability as a borrower. Lenders need a quick and efficient way to judge the risk of handing out money without reading through hundreds of pages of your personal bank statements. They rely on complex algorithms that distill your entire history of borrowing and repaying into a range between 300 and 850. For example, if you consistently pay your bills on time and keep your debt low, the algorithm rewards you with a higher score that signals low risk. Conversely, missing payments or maxing out cards suggests you may be in over your head. This score acts as a universal language for banks and institutions to decide if they want to do business with you. It is essentially a grade for your behavior with money that follows you throughout your adult life. Your credit score does not just appear out of thin air, but is generated by 3 major institutions. These companies are Equifax, Experian, and TransUnion, and they function as the ultimate record keepers of your financial history. They collect data from your credit card companies, mortgage lenders, and even utility providers to build a comprehensive report of your habits. Imagine that each of these bureaus is like a different teacher grading the same student. While they might have slightly different information, their goal is the same, which is to create an accurate profile of your creditworthiness. This is why you might see a slightly different score when you check different apps or websites. Maintaining a clean record with all 3 is vital, because you never know which one a future lender will choose to look at when you apply for a loan. The single most influential factor in determining your credit score is your payment history. This component accounts for 35% of your total score because it is the most direct predictor of future behavior. Lenders want to know if you have a track record of fulfilling your promises and paying back what you owe on the agreed date. For example, even a single payment that is more than 30 days late can cause a high credit score to plummet by over 100 points in a single month. This happens because the system assumes that one missed payment is a sign of broader financial instability. If you want to maintain a high score, you must treat your due dates as non-negotiable commitments. Consistency is the primary engine that drives your credit score higher over the long term. The second most influential factor in your score is known as credit utilization. This refers to the percentage of your total available credit that you are actually using at any given time. Lenders look at this because they want to see that you can have access to a large amount of money without the urge to spend every last cent of it. If you have a credit card with a limit of $1,000 and you carry a balance of $900, you are using 90% of your limit, which looks very risky. However, if you keep that balance at only $100, you are showing incredible restraint and financial stability. Keeping this ratio below 30% is one of the fastest ways to maintain a healthy score. Length of credit history is another vital piece of the puzzle that accounts for 15% of your score. This metric measures how long your accounts have been open and the average age of everything on your report. Lenders prefer borrowers with a long history because it provides a much larger sample size of their financial behavior over time. Think of it like a friendship, where trust is built over many years rather than just a few weeks of knowing someone. If you close your oldest credit card account because you no longer use it, you might accidentally lower your score by shortening your average credit age. It is often better to keep old accounts open, even if they have a zero balance, just to preserve that historical data. Patience is a virtue in the world of credit, and time is a powerful ally. Credit mix is a smaller but still significant factor that makes up 10% of your score. This refers to the different types of credit accounts you manage, such as revolving credit and installment loans. Having a diverse portfolio shows lenders that you are capable of handling various kinds of debt responsibly. For instance, a person who successfully manages a credit card, a student loan, and an auto loan is seen as more experienced than someone who only has a single credit card. You do not need to go out and take out loans just for the sake of your score, but having a variety of accounts will naturally help you over time. It proves that you can navigate different repayment structures and interest rates effectively. The final piece of the scoring model is new credit, which represents the remaining 10% of your score. This factor looks at how many new accounts you have opened recently and how many hard inquiries have been made on your report. Lenders get nervous when they see someone applying for multiple lines of credit in a short period because it can signal financial distress. If you apply for 5 different credit cards in a single month, it looks like you are desperate for cash, which increases your perceived risk level. Each hard inquiry usually drops your score by a few points for a temporary period. It is best to be strategic and space out your applications by at least 6 months whenever possible. Understanding why these numbers matter starts with the concept of the cost of money. A high credit score gives you the power to borrow money at a much lower cost through reduced interest rates. Over the course of a 30-year mortgage, the difference between a good score and a great score can result in saving over $100,000 in interest payments alone. Imagine being able to buy a higher quality home or retire years earlier, simply because you managed a 3-digit number correctly. This is not just about bragging rights, but about the actual purchasing power of your income. When you pay less in interest, more of your hard-earned money stays in your pocket. Your credit score also has a profound impact on aspects of your life that have nothing to do with borrowing money. Many landlords now require a minimum credit score before they will even consider your application for an apartment. Some employers, especially in the finance or government sectors, also check credit reports to ensure their staff is responsible and not under extreme financial pressure. Even your car insurance premiums can be higher if your credit score is low, because data shows a correlation between credit and risk. It is a universal grade for your reliability in modern society. Whether you are renting a home or applying for a job, your score is working for you or against you behind the scenes. If you are starting from zero, building a credit score requires a proactive and strategic approach. You cannot be judged on your habits if you have no history, so you must find ways to enter the system safely. A secured credit card is one of the best tools for beginners because it requires a cash deposit that serves as your credit limit. For example, by putting down a $200 deposit and using the card only for small groceries, you can build a solid foundation within 6 months. Another great option is becoming an authorized user on a parent or partner's account if they have excellent habits. These small steps create the momentum needed to access better products. Monitoring your credit report is just as important as building the score itself, because errors are surprisingly common. You are entitled to a free credit report from each of the 3 bureaus every year. Sometimes a bank might report a payment as late when it was actually on time, or you could even be a victim of identity theft. If an error exists, it can weigh down your score for years without you even realizing why you are being denied for loans. By catching these mistakes early and filing a dispute, you can often see a significant jump in your score. Checking your own score does not hurt it, so stay informed and stay vigilant. Mastering your credit score is one of the most rewarding financial journeys you can take. We have covered the 5 main pillars: payment history, debt, age of accounts, credit variety, and new applications. Think of your credit as a garden that requires consistent care and attention. If you found this breakdown helpful, please hit the like button and subscribe for more deep dives. We would also love to hear from you in the comments section below. Tell us, what was the very first credit card you ever opened, and how did it help you get started?